All right, now that's gonna seem like phony data because of how well it actually illustrates my point. Every now and then when I'm talking to an investment client or another advisor, it's sometimes clear to me that they are missing a key prerequisite to truly understand what I'm trying to communicate to them. Today, I wanna discuss one of the most common building blocks of understanding that I was missing early in my life, and now I observe many other people missing in their financial strategy, but also in life itself. First of all, let me tell you a story. From age 0 to 18, things probably couldn't have gone much better for me. I was born to loving, supporting parents that told me I could achieve whatever I wanted. I was the popular kid in school, the captain of all the sports teams. I was the student body president of the high school, the articles about me in the press, the whole bit, right? Josh, get off your high horse. But all this did was raise my expectations for what my life would be. And after graduating with starry eyes and all ambitious, the world hit me hard. I hit roadblock after roadblock in my career, and not to mention one personal or family crisis after another. I started to accumulate baggage. I became heavier and heavier and slower in my progress, and I realized that I was being passed by my peers, and not to mention all the people on social media who made me feel like I was the furthest thing from a real outlier. And so I went through a true crisis, realizing that everything I had told myself about who I was and why I was special was a lie. Josh, this is kind of sad. Why are we going through all of this? Well, I want to introduce a concept that helped me with this and also helped me as an investor and a financial advisor. Here's a key concept. The more instances of a random event we can produce, the closer and closer we'll get to defining the true probability of a desired outcome. Now that sounds confusing, but we call this the law of large numbers. To make it simple, let's do this. I'm going to flip this little coin over and over, and I'll do it in fast motion to save you the time, and we're gonna document the results of each flip. By the way, this is a Canadian toonie. It's kind of cool, hey? Little gold thing in the middle. Apparently if you poke the middle out, they'll give you like $100 or something. That might be a myth. All right, let's get started. All right, now that's gonna seem like phony data because of how well it actually illustrates my point. I swear to you, I put in the exact thing that came up. And you're gonna see why this helps me communicate what I'm really after. It was actually the perfect take. But what I'm gonna do now is I am going to put color back into some things that I actually blacked out. And what we're gonna find is really interesting here is that as we go through these instances, we can see that the first 3 flips were heads. And so 100% of our flips were heads, and then a tails came along and changed it to 75-25. And so the whole idea here, as you can see, there are groupings where we flip the same thing over and over, even though we know the odds are 50-50. We get to a point by the 4th flip where it's 75-25. The odds of flipping heads or tails are not 75-25, it's 50-50. But the whole point of the law of large numbers and what I'm trying to communicate is that the more instances of an event that we have, the closer we get to the true probability, which we know is 50-50. And hilariously, by the end, we get to 50-50. The reason is because as we create more instances, each individual instance creates less weight in the overall outcome. When we have 10,000 flips, it's gonna be exactly 50-50. When we have 5 flips, sometimes we have some insanely skewed outcome. And so my point here is this: in life, we could have something that's working, like a certain marketing strategy to get more clients or an investment strategy for our own money. The problem is that we need a large enough number of instances or repetitions to truly define if something we're doing is actually working. The point I'm getting at here is that as we go through life, we might find that, let's say heads is considered winning and tails is considered losing. We can go through streaks on our life where we get on runs of massive wins and runs on massive losses. But the reality is that we need iteration, we need more repetition where we can actually see the truth of our decisions and their outcomes. From there, we can separate luck from skill and define what actually needs to change about what we're doing. But what is it that we want to change? Now we're gonna add in another layer to this whole idea called asymmetric upside. What if we ascribed a value to each one of these coin flips? Let's say we're going to bet $1 on every single flip. Heads, we get $1.50 back, and tails, we get 75 cents back. So heads, we gain 50 cents, tails, we lose 25 cents. And so if I go over here and put some color in these texts that have been calculated, what you'll see is what would have happened is we would have gained, and then we would have lost, gained, lost. And what you can see here is that by the end, even though we have something that is a 50-50 probability, we are not winning more than we are losing. But since we gain more when we win than we lose when we lose, we end up net a whole bunch of money. We end up doubling our money and then some. In gambling, in markets, we call this having an edge. This means that if we can just flip the coin as many times as possible, we will get further and further ahead, but not in every instance. There are times when we lose a lot in a row, and there are times when we win a lot in a row. And these random outcomes can screw with our head in terms of how are we doing relative to a benchmark. But this idea of finding opportunities where when we win, we can win more than we lose when we lose, that is asymmetric upside. It's not symmetrical. We don't win 50 cents on one side and lose 50 on the other. We win 50 cents but only lose 25 cents. And as investors and as advisors, what we want to be doing is taking as many asymmetric bets as we can over the course of our life. That's our primary focus. Now, we already believe this and we preach this, right? The stock market itself, as judged by an index like the S&P 500, it itself is an enduring tool of asymmetric upside. It goes up more than it goes down, and when it goes up, it goes more than it goes down. In life, this might mean trying new marketing strategies, trying new communication methods. For me, things like starting a YouTube channel was something I perceived to be asymmetric upside. Worst case, I wasted a lot of time and I got a lot of hate comments, and my friends and other people around me thought I was cringe. Best case, it would bring brand value, it would bring a stream of clients, and it would allow me to meet a bunch of people and network. And that's not even to mention like the revenue or the sponsorship money or anything like that. But asymmetric upside can also be manufactured by becoming more skillful. If you can hone your sales skills, for instance, you're going to increase the probability of a win. This is no longer 50-50, it might now become 60-40 or 70-30. Now, asymmetric upside can be manufactured. You can create scenarios in your life and in your business where you have higher odds of success, and when you do have success, the payout is larger. And if you can hone your sales skills, you're going to increase the probability of a win given the same number of instances or opportunity. And by the way, if you're a financial advisor looking to increase your edge in terms of how well your marketing is received, or how well you can close prospects when they are interested, or how well you can create successful client outcomes when they are your clients, you gotta check out the Advisor Accelerator in the link below, where we have a group of advisors all around the world learning best practices on how to build our businesses, deliver better results for clients, and create our dream career. So go check that out if you're interested. But the last concept that makes everything really difficult, well, what if the edges that we found, those asymmetries we could identify, are constantly changing? And as the world discovers new edges, they get arbitraged away as people figure out about them. And that forces us to go and find a new edge. Well, that's what life and investment markets are actually like, but we'll save that one for another day. In my personal life, things kind of went perfect for the first 18 years, just like in my example where I flipped heads over and over and over again. Going through that, you might realize, wait a second, if you flip heads enough times in a row, you start to doubt, is this really 50-50? But this gave me that false sense of self that I was some sort of incredible outlier destined for greatness, when in reality, I had just flipped heads like 10 times in a row. But the awesome realization behind all of this is that I wasn't necessarily a useless loser, I had now just flipped tails too many times in a row. Either that, or I had yet to identify a large enough asymmetric edge that I could run repeatedly over and over, whereas maybe the successful people in my life had. And they had also done so while probably flipping heads 10 times in a row with the asymmetric edge. So the big takeaway, our job as investors and as advisors shouldn't be to constantly measure ourselves or our actions towards some ideal or benchmark on an instance by instance basis, or even at all. We really shouldn't invest much time thinking about how far we've exceeded or fallen short of our expectations. It should be something more like go out into the world with an eye out for asymmetric bets that we can find and take them over and over again. If we do this, it's statistically improbable that we won't find the success we're looking for in time. Now, hopefully this gave you some good insights into the power of stick-to-itiveness, how we can find and manufacture our own asymmetric bets by building our skills and making the right decisions, and how we should really measure the quality of our actions in our lives by the quality of the repetitions that we put in, rather than the random events that come out on the other side relative to what we expected. And so with all that, thank you so much for watching. We'll see you next time.